Ever wondered if your future self will be sipping cocktails on a beach, living life on their own turn, or maybe infecting emails, kind of trapped in the daily grind? Today, we're plunging headfirst into the ever-evolving world of retirement planning. And trust us, it's packed with more surprising facts or practice. Welcome to another deep dive. This is where we take a stack of compelling information and, distill it into the most important nuggets of knowledge, custom tailored for you. Our focus today, a comprehensive look at consumer trends and vital news related to retirement, all pulled directly from the consumers.app website. And this snapshot of trends and developments is hot off the press from June 14th, 2025. So it gives us an incredibly current picture. Our mission is pretty simple: to help you feel truly well-informed about securing your financial future, no matter where you are on your journey.
Yeah, and what's truly fascinating, I think, is how these headlines, they seem kind of disparate, right? Different age groups, different financial situations, but they actually weave together. They paint a surprisingly cohesive picture of the challenges and the opportunities in retirement planning right now. We'll be navigating everything from the fundamental importance of just having a plan to making smart choices about your early career savings, understanding the unique landscape facing younger generations, and even mastering the art of, drawing down your savings when the markets are going wild.
All right, let's unpack our first big headline then. This one's straight from Money Talks News on MSN.com. Retirement bliss. Why? It's crucial to have a plan. On the surface, that sounds like, common sense, doesn't it? But what did consumers' research uncover about why this foundational step is so profoundly crucial? Beyond the obvious, I mean.
You're right. It seems straightforward, but its depth is often underestimated. At its core, retirement planning is really about assessing your readiness for the retirement age and the lifestyle you actually envision. It's about building your financial know-how and cultivating, consistent saving habits. The ultimate goal here is achieving genuine financial independence, that freedom to support yourself without being tied to a job. Proper planning basically ensures you've got the necessary savings or income streams to maintain your desired standard of living comfortably.
So it's not just about the numbers on a spreadsheet. It's about actively designing that bliss you mentioned and then charting the course to actually get there. But if knowledge is power, why aren't more people, engaged?
That's a critical point, and it's where things get really interesting. There was a study out of Japan using their 2022 financial literacy survey, and it found something pretty counterintuitive. Simply having financial literacy doesn't directly increase engagement, not in investment or retirement planning, which raises a crucial question for policymakers, for educators. If knowing isn't enough, what does bridge that gap? The gap between understanding and action for the average person. What other motivators are needed to spark genuine engagement?
That's a huge insight. Wow. The real challenge isn't just delivering information, but activating that knowledge into concrete steps.
And speaking of activation, or maybe deactivation, what happens to our minds when we actually stop working?
It's a sobering thought, yeah, but research confirms it. A study from the China Health and Retirement Longitudinal Study, looking at older adults, found that leaving the workforce can negatively impact cognitive function, particularly things like situational memory and overall mental agility. And this is especially true for those in rural areas. Wow. So retirement isn't just a financial pivot point. It's a profound mental and lifestyle transition too. Is there any way to mitigate that cognitive shift?
Absolutely. The same research highlights that staying engaged, through social activities and even internet use can significantly reduce these negative effects. Think of it like keeping your brain active, right? These activities provide mental stimulation. They foster social interaction, which can enhance memory, boost your mood, and importantly, combat isolation. And this ties into broader research showing that your retirement decisions are heavily influenced by your income and how much you value leisure time. There are specific income thresholds, apparently, that determine when early retirement becomes truly feasible. It just underscores that it's always this delicate balance between the financial realities and your desired lifestyle.
Okay, so it's about a holistic approach then. Not just making sure your money lasts, but ensuring your mind stays sharp and your life remains full and engaging. Now, while pensions historically offered some peace of mind, our research suggests they might not be enough anymore. Why is planning beyond pensions so vital today?
Well, pensions provide a regular income, sure, but they often aren't sufficient to cover all expenses or sustain a, let's say, comfortable lifestyle in modern retirement. Personal retirement plans, whether it's through savings or investments, they offer that crucial additional security and flexibility. They allow you to maintain your standard of living, manage those unexpected costs that inevitably pop up, and simply live without constant financial stress. And to really improve readiness, individuals should focus on practical steps, like increasing their savings rate, investing wisely, strategically reducing debt, and regularly reassessing their financial goals. That's key. And of course, continuously expanding your financial knowledge and maybe consulting with a trusted financial advisor that can be a game changer.
That's a powerful framework, moving from the why to the how. Very practical. And speaking of practical, here's where it gets really interesting for a younger listener, someone maybe just starting out, facing those big decisions about saving for that, well, distant future. Next up, a question lots of young people are wrestling with from AOL. Should I prioritize my 401k with a 25% match or go for a Roth IRA at 24 years old?
This is a classic dilemma, isn't it?
It absolutely is. And understanding the core differences is really key here. A 401k, typically employer-sponsored, right? You contribute pre-tax dollars, and often your employer offers a match, which is effectively, free money. You then pay taxes on withdrawals way down the line in retirement. A Roth IRA, on the other hand, that's an individual account. You contribute money you've already paid taxes on after tax. The magic there is that qualified withdrawals in retirement are completely tax-free. So the 401k gives you those immediate tax breaks now, while the Roth IRA offers that tax-free growth withdrawal later on.
And that employer match, that truly is a no-brainer, right? It's like finding free money. It's even better than that. Seriously, with a 25% match, let's say you put in $4,000 a year. Your employer instantly adds another $1,000, just like that. That's $1,000 you didn't have to earn, immediately boosting your savings to $5,000. And this significantly accelerates your funds growth, leveraging the power of compound interest over decades. It's truly money you just don't want to leave on the table.
Okay, so with a Roth, I'm sort of biting the tax bullet now, paying taxes up front. But gaining that tax-free access later, for a 24-year-old, does that usually pencil out better in the long run?
For a young adult, yeah. A Roth IRA can indeed be incredibly beneficial because you have such a long time horizon for your money to grow, right? That tax-free growth over decades can compound into a massive sum. And if you anticipate being in a higher tax bracket in retirement than you are now, which is pretty common for someone just starting their career, then paying those taxes today at your likely lower rate means those future higher withdrawals are completely tax-free. Plus, the Roth IRA offers a unique flexibility. You can withdraw your contributions, not the earnings, just what you put in at any time, penalty-free, which can act as a crucial financial safety net for emergencies.
That's a fantastic strategy, kind of balancing both worlds. So if a young person wanted to optimize their savings right now, what's the combined approach that Consumers Research recommends?
Yeah, the optimal combined strategy generally is to first contribute enough to your 401k to secure the full employer match. Get all that free money. That's your foundation once you've maxed that out. Then direct any additional savings you can afford into a Roth IRA. This approach diversifies your tax treatment in retirement, which gives you crucial flexibility later on. You have options. When making these decisions, though, you always need to consider your current versus your expected future tax bracket. Also, the specific employer match offered, the contribution limits for each account type, their unique withdrawal rules, any liquidity needs you might foresee, and of course, the investment options available within each account. Lots to weigh up.
That's incredibly practical advice.
Right.
Really helpful. Now, shifting gears a bit, to a generation that often faces a very different financial landscape, Marky asks, retirement contingency plans, what Gen Z can start implementing now? It truly is never too early to plan, is it?
Oh, absolutely vital to start early, especially for Gen Z. One of the biggest risks in retirement isn't just, not saving enough. It's outliving your savings, running out of money. So the focus for this generation really needs to be on smart decumulation strategies, which is just a fancy way of saying, how do you spend down your retirement savings in the smartest way possible, making sure it lasts? Even with inflation chipping away at it, it's all about minimizing the probability of, financial ruin.
That sounds incredibly complex to figure out on your own, especially with all the variables of a long life and markets and everything. Are there any, cutting-edge tools that can help demystify this?
Definitely. There's new research highlighting how advanced AI, specifically something called deep reinforcement learning, can be used to create highly intelligent financial agents. Think of it like having a super smart AI constantly optimizing your personalized portfolio allocation and saving strategies. In real time, these systems can actually account for your unique, varying income paths and different employment types, offering a truly tailored approach to planning that goes way beyond just generic advice.
Wow. So AI and machine learning are moving us beyond generic advice to truly personalized financial coaching. That's actually really empowering. And what about balancing the risks involved? We all have different comfort levels.
Precisely. Your personal comfort level with liquidity needing cash on hand and investment risks significantly impacts the ideal way you should plan to draw down your savings later. A smart framework considers these differing appetites, right? Helping to align your financial goals with your personal risk tolerance. For Gen Z, the practical steps are pretty clear. Start saving consistently now. Even small amounts add up. Diversify your investments broadly. Don't put all your eggs in one basket. And leverage financial technologies like robo-advisors. They can make it easier. These actions harness the power of compounding over time and build a more robust foundation for managing market risks down the road.
It's also fascinating how the landscape of pensions has fundamentally shifted for this generation too, isn't it? That safety net isn't quite the same.
It's a profound change, yeah. The broad shift away from traditional defined benefit pensions, where your employer guaranteed a set income for life, to defined contribution plans like 401k. Well, it has placed the entire responsibility for retirement savings squarely on the individual. This means Gen Z must actively manage their savings. They have to make informed decisions about investments and contributions to secure their own future. And to your point about tech, innovation is paramount here. It provides accessible tools that enhance financial literacy, automate savings, and optimize investment strategies, often through these sophisticated AI and machine learning platforms we've been discussing.
It's truly empowering, I agree, to see how technology and even behavioral insights can help the younger generation get ahead. Because ultimately, it's not just about the numbers, right? It's about understanding human behavior too, our own quirks.
Absolutely. Gen Z can gain a significant edge by leveraging behavioral finance insights. This means understanding common cognitive biases that affect our financial decisions. Things like procrastination, we all do it, or maybe overconfidence. By recognizing these natural tendencies, they can implement clever strategies, like setting up automatic savings plans, to essentially trick themselves into better long-term outcomes and mitigate those biases, make it automatic.
Okay, but what happens when you are retired? You've done the saving, you're relying on those funds, and then the market decides to go completely wild. This is a huge, palpable concern for so many people. Which brings us to a critical question, especially for those already retired or getting close. This is from the New York Times. How to draw down your retirement savings when the markets are gyrating. This is where strategy isn't just important, it feels absolutely essential for peace of mind.
It genuinely is. When markets are volatile like that, the main strategies for withdrawing your funds usually involve employing a flexible withdrawal rate, meaning you might take out a little less in down years, if you can, or temporarily reducing your discretionary expenses, cutting back on the non-essentials. Another popular method is the bucket strategy, where you kind of segment your funds into different risk levels for different time horizons. And then there's the famous Trinity study. It provides a widely referenced guideline, a 4% withdrawal rate. That's seen as a historical benchmark for portfolio longevity, balancing your spending needs with preserving your capital. However, it's really important to note that for very early retirement or during particularly severe market fluctuations, some financial planners suggest a more conservative rate, maybe closer to 3.25% or 3.5% to be safer.
So the Trinity study is kind of like the North Star for withdrawal rates, but maybe with a warning label attached.
Exactly. It's a powerful guideline, but definitely not a rigid rule you can just set and forget. Retirees also face unique challenges in what researchers call a jump diffusion market. Fancy term. It basically means markets don't just gently drift up and down. They can have sudden, sharp drops or surges, jumps. Research indicates that this, combined with something called habit persistence, meaning it's just hard for people to change their spending habits quickly, even when conditions change. Well, that can complicate optimal retirement decisions. These jump risks can necessitate discontinuous investment strategies, making planning incredibly complex during periods of high volatility.
So even with a solid plan, the market itself can throw a massive wrench in the works, unexpectedly. What are financial products specifically designed to offer some protection during these volatile times? Are there options?
Yeah, that's where structured investment products like principal protected and index retirement accounts or pre-berries come into play. Think of them as a kind of compromise. They offer principal protection, meaning your initial investment is largely safe, and they offer tax deferral. However, research suggests that while pre-berries might have a slightly higher expected return than, say, U.S. bonds after tax, they generally tend to underperform direct stock market investments over the long term. So they're primarily suited for very risk-averse investors, people who prioritize capital protection above maximizing potential growth.
Okay, sounds like that classic trade-off. Safety versus potential upside. You give up some potential return for more security, and how much risk a person is genuinely comfortable taking or maybe able to take really impacts this, doesn't it?
It's absolutely crucial. Researchers talk about risk capacity, which is your actual ability to withstand financial losses without derailing your life goals. It's not just your psychological willingness to take risks. Those with higher risk capacity, perhaps they have a larger financial cushion or other income sources. They can remain more neutral to market movements. They can ride it out. However, those with lower capacity might need to actively adjust their investments or even their spending to meet their needs when the market is turbulent. And your risk capacity isn't static either. It can change over time depending on your circumstances, and that directly impacts your ideal asset allocation.
This raises an important question then. What about those really ambitious individuals, the ones who aim to retire much, much earlier than the traditional age? Which brings us neatly to our final topic. Let's tackle a movement that has really captured the imagination of, well, an entire generation, it feels like. The FIRE movement. Our last headline comes from The Motley Fool. FIRE fundamentals. How much do you really need to retire early?
Right, the FIRE movement. FIRE stands for financial independence, retire early. And the core principle is really about aggressively maximizing savings and investments. Super high savings rates. The goal is to accumulate enough assets that generate sufficient passive income from investments, rentals, whatever, to cover all your living expenses, which allows you to leave traditional employment decades before the typical retirement age. It strongly advocates for extreme frugality, living on much less than you earn, and highly strategic investment.
And there's that famous rule that's become almost synonymous with the FIRE movement, isn't there? The percentage.
Yes, the 4% rule. We touched on it earlier for withdrawals, but for FIRE accumulation, it works in reverse. This guideline suggests saving 25 times your anticipated annual expenses. So if you plan to spend, say, $40,000 a year in retirement, you'd aim for a portfolio of $1 million. 4% of $1 million is $40K. However, for those looking to retire very early, maybe in their 30s or 40s, some more conservative approaches recommend saving 28 to 30 times annual expenses, just to build in an extra layer of stability, accounting for that potentially much longer retirement period and market uncertainty.
It sounds incredibly appealing on the surface. I mean, the ultimate dream of freedom from the 9 to 5. But is it genuinely achievable for everyone, or does it face some pretty real-world hurdles?
Oh, it definitely faces significant criticisms regarding its accessibility. The really aggressive savings requirements, sometimes 50%, 60%, even 70% of your income, and the need for substantial initial capital. Well, that can make it genuinely difficult, maybe impossible, for many people to achieve, especially those with lower incomes or high cost of living areas, or people who simply aren't able to drastically reduce their expenses due to family or health reasons. It's certainly not a one-size-fits-all solution for financial independence.
And you mentioned earlier how income and leisure influence retirement decisions generally. Does that hold true for the FIRE movement as well?
It absolutely does. That same research on optimal portfolio consumption and retirement decisions. It highlights that income thresholds are key determinants for when early retirement even becomes feasible. And your personal valuation of leisure, how much you value free time versus more income, significantly impacts your consumption and portfolio choices once you are financially independent. It's always about finding that precise balance between your financial capabilities and your desired lifestyle, even within FIRE.
And circling back to that intriguing Japanese study we discussed earlier about financial literacy not directly increasing engagement. Does that hold true even for a seemingly highly motivated group like the FIRE community? People who are actively seeking this stuff out?
Interestingly, yes, the implications seem to apply. The finding that financial literacy alone doesn't directly increase engagement suggests that for FIRE too, simply understanding the mathematical concepts, the 4% rule, compound interest might not be enough to motivate the extreme savings and lifestyle changes required. There's clearly a strong psychological component at play. Other motivators, perhaps that strong sense of online community or the aspirational lifestyle itself, are often needed beyond just the raw financial knowledge. It's about more than just the numbers for them too.
Yeah, it's clear there are so many paths to financial independence, aren't there? Each with its own benefits, its own challenges, even its own unique behavioral quirks.
That's spot on. And even the tools designed to help, like those online retirement calculators that project your future income. Well, one study titled On Track for Retirement found they had a negligible impact on actually increasing people's contribution rates, which again points to this kind of disconnect between readily available financial tools and actual saving behavior. Knowing isn't always doing.
But the FIRE movement itself, even with its challenges, became wildly popular, especially among millennials. What do you think fueled that widespread adoption.
Yeah, it gained massive traction among millennials, particularly in the 2010s. This was largely driven, I think, by the rise of highly engaged online communities, blogs, forums, podcasts that passionately promoted the FIRE lifestyle. Combine that with maybe this generation's strong desire for true financial independence, for greater flexibility in their lives, and the increasing accessibility of online information and detailed planning strategies. It really fueled its widespread popularity, and it continues to inspire many today.
Wow. We've covered so much ground today. From the fundamental importance of just having a plan and that classic Roth versus 401k debate, to navigating market volatility in retirement and the, well, highly aspirational FIRE movement. The underlying truth, though, the common thread woven through all these insights, seems to be this. Knowledge, when you combine it with intentional action, truly is power when it comes to securing your future.
I agree. And if we connect this to the bigger picture, it's clear that while the whole landscape of retirement is constantly shifting, the core principles remain. Things like proactive planning, deep adaptability, and genuinely understanding your own unique financial situation and life goals. Those remain absolutely paramount, which I think raises an important question for you, our listener. How will you define retirement bliss for yourself? And maybe more importantly, what's the very first step you'll take or perhaps reevaluate on your own path towards it?
We truly hope this deep dive is giving you some value, to maybe a few aha moments you can carry forward. If you found this helpful, please be sure to like, share, and subscribe to Consumers 360 wherever you get your deep dives. It really helps others buy you shit. Until next time. Thank you so much for joining us for this deep dive into consumer trends and news.